Why a June rate cut could trigger the next big stock market rally, the pivot investors have been waiting for. After a turbulent 18 months marked by aggressive rate hikes to combat inflation, the Federal Reserve may finally be preparing to pivot. With inflation easing, growth stabilizing, and financial conditions tightening in pockets of the economy, a June 2025 rate cut is no longer just speculation, it's becoming a highly anticipated reality. And if this happens, the consequences for the stock market could be massive. Investors are gearing up for a potential breakout moment, a shift that could unleash a multi-quarter bull run fueled by liquidity, valuation expansion, and sector rotation. The setup. What led us here? To fully grasp the bullish potential of a June rate cut, we must understand the conditions leading up to it. A. From tightening to easing. Throughout 2023 and 2024, the Fed engaged in one of the most aggressive tightening cycles in history, pushing the federal funds rate to a peak of 5.75%. The goal was clear: tame the worst inflation spike in over 4 decades. And while it came at a cost, dampened consumer spending, rising credit stress, and muted earnings growth, the policy ultimately worked. Now in mid-2025, inflation has moderated to 2.3% year, wage pressures are easing, and the labor market, while still healthy, is showing signs of cooling. B. Markets are forward-looking. The stock market doesn't wait for confirmation, it moves on expectations. And expectations are clearly shifting. Fed futures markets are pricing in a 65 to 75% probability of a rate cut in June, according to CME Fed Watch data. Wall Street strategists, from Goldman Sachs to Morgan Stanley, are revising forecasts to reflect a Fed pivot. The bullish domino effect of a rate cut. When the Fed cuts rates, it isn't just a headline, it initiates a chain reaction across asset classes and investor psychology. Here's how a single cut could trigger a massive bull rally. A. Liquidity floodgates open. Lower rates reduce borrowing costs for corporations and consumers alike. Capital becomes cheaper. Expansion projects get greenlit. Consumers refinance debt and increase discretionary spending. Result? Corporate earnings projections get lifted, and stock prices follow. B. Valuation expansion. Interest rates directly impact the discount rate applied to future earnings. When rates fall, valuation multiples expand. Sectors like technology, growth, and innovation, many of which trade on future cash flows, stand to benefit most. A rate cut in June could send the S&P 500's forward P/A ratio surging from 19x toward 21 to 22x, providing a major lift in index levels even before earnings revisions kick in. C. Risk on sentiment returns. Let's be clear, investors are starved for clarity. A Fed pivot removes uncertainty from the equation. It signals to markets that the worst of the tightening cycle is over, and that monetary policy will now support growth instead of suppressing it. That's a green light for hedge funds, retail traders, and institutions to rotate out of cash and bonds into equities. There's historical precedent for why stocks tend to rally after the Fed's first rate cut in a cycle, especially when it's not tied to a recession. Past performance after first cuts. Let's look at a few examples. 1995, the Fed cut rates after a soft landing. The S&P 500 rallied 34% over the following 12 months. 2019, the Fed cut rates amid global trade fears, not a recession. Stocks surged over 25% in the next year. 2024, Q4, markets began pricing in a cut. Nasdaq and S&P gained over 18% from the October low. The key takeaway? When the economy avoids a hard landing, rate cuts are jet fuel for equities. Goldilocks scenario: soft landing plus rate cut. The market's dream scenario: a Goldilocks economy with moderate growth, falling inflation, and easing policy looks increasingly likely. A June rate cut would confirm this environment, and history shows that such combinations produce the strongest risk-adjusted returns. Which sectors could lead the rally? A rate cut doesn't lift all boats equally. Certain sectors tend to outperform dramatically in the early stages of an easing cycle. A. Technology and growth stocks. Tech and high-growth companies, particularly those with long-duration cash flows, are most sensitive to interest rate shifts. Expect a surge in AI leaders, Palantir, PLTR, Nvidia, NVDA, AMD, Cloud, Software as a Service, Snowflake, Datadog, ServiceNow, Consumer Tech, Apple, Amazon, Meta. These stocks have already started to rebound in anticipation of easing, and June could kick off the next leg up. B. Financials. While banks traditionally benefit from higher rates, the rate cut will steepen the yield curve, improving net interest margins. Combine that with lower default risks and rising loan demand, and you've got a recipe for a financial sector breakout. Watch for JP Morgan, Bank of America, Visa, PayPal, C. Consumer discretionary, lower rates equals cheaper credit equals stronger consumer spending. Brands like LVMH, Nike, Starbucks, and Tesla tend to thrive when liquidity returns to the economy. Investor positioning, the fuse is already lit. A. Cash on the sidelines. There's still an estimated $6 trillion sitting in money market funds, earning 4 to 5% in yield, yes, but also waiting for a sign to re-enter risk assets. A Fed rate cut will erode those yields quickly, pushing investors back into the stock market. B. Retail and institutional inflows. Retail investors are regaining confidence. Google Trends shows searches for best stocks to buy now are surging, while fund flows into ETFs like SPY, QQQ, and ARKK have been sharply rising since April. Institutional sentiment is also warming, with hedge funds increasing long exposure in growth-heavy sectors in the last 2 weeks. Macro confirmation, inflation down, recession risk fading. A. Disinflation continues. The most recent CPI report showed headline inflation at 2.3%, with core PCE down to 2.5%, well within striking distance of the Fed's target. Goods inflation is negative, while services inflation is moderating. This gives the Fed a clear runway to ease. B. Labor market equals resilient but cooling. Job openings are down from their peaks, and wage growth has stabilized at 3.8% year. The Fed no longer fears a wage price spiral. Unemployment sits at a healthy 4.0%, supporting the soft landing narrative. Geopolitical and global tailwinds. While domestic monetary policy is center stage, external forces add fuel to the bullish case. China is easing policy to support growth. Europe is stabilizing after a mild recession. Global central banks, BOE, ECB, BOC, are also shifting dovish. This synchronization amplifies liquidity conditions across borders, which tends to favor multinational US companies and global tech. Potential risks, and why bulls still win. Of course, no outlook is risk-free. A few potential headwinds include inflation re-acceleration, unlikely but possible, geopolitical shocks, Middle East, Taiwan, Russia, earnings disappointments. But here's the truth: bull markets climb a wall of worry. Even during past rate cut cycles, volatility didn't derail the overall upward trajectory. If the Fed cuts and the economy holds, the risk-reward skew tilts dramatically toward the upside. Conclusion: June 2025 could be the launchpad. The writing is on the wall. All signs point to a June rate cut as a defining moment in this market cycle. And for savvy investors, it could be the ignition point for a massive bull rally. We are entering a window where inflation is easing, growth is holding steady, the Fed is prepared to support markets, valuations still have room to expand. Add it all up, and you have a once every few years opportunity to position ahead of a liquidity-driven rally. So whether you are trading tech, investing in quality growth, or allocating to ETFs, get ready. Because the Fed's June pivot could turn 2025 into a banner year for equities. Final words. Smart investors don't chase headlines. They position ahead of catalysts. And the rate cut in June, if it arrives as expected, might be the most powerful bullish catalyst we've seen since the pandemic recovery. Are you ready to ride the wave?